I think we all want to go to the moon, but if you want to ride the rocket, you got to be prepared to pull the G's. Over 5 years, Bitcoin's had like 6 brutal drawdowns. If you roll the clock back 13 months, we were sitting around 68,000. And then after the Trump election, we had this incredible rally from 68 to 106,000 in 5 weeks. If you go back 14 months, we were about 55,000. And so if you'd said we're going to go from 55,000 to 94,000 in 14 months, that would have exceeded any reasonable investor's expectations. Over 5 years, Bitcoin's up about 50% a year on average for the 5 years. Gold and S&P are studying the cost of capital at 14%. My company's strategy is up 71%, equivalent to NVIDIA. There's no other stock in the S&P that's done any better. So I think the volatility comes with the territory. If you're going to be a Bitcoin investor, you need a 4-year time horizon, and you need to be prepared to handle the volatility in this market.
Is Bitcoin capable of reaching 150,000 by the end of the year? Instead of giving a simple yes or no, Saylor pulls back and reframes the discussion entirely. He points out that riding the Bitcoin rocket means being ready for the intense G-forces, reminding us that in just the past 5 years, the asset has gone through 6 steep and punishing drawdowns, each one enough to shake out investors without strong conviction. Before we dive in, take a moment to like the video, subscribe, and turn on notifications so you don't miss future content. Feel free to explore our other videos covering cryptocurrencies and the broader digital asset world. Share your thoughts in the comments. Every interaction supports the channel and helps it grow. Thanks for watching, and enjoy the video.
What do you think? 150 by the end of the year? What do you think's happening here?
I think we all want to go to the moon, but if you want to ride the rocket, you got to be prepared to pull the G's. Over 5 years, Bitcoin's had like 6 brutal drawdowns. If you roll the clock back 13 months, we were sitting around 68,000. And then after the Trump election, we had this incredible rally from 68 to 106,000 in 5 weeks. If you go back 14 months, we were about 55,000. And so if you'd said we're going to go from 55,000 to 94,000 in 14 months, that would have exceeded any reasonable investor's expectations. Over 5 years, Bitcoin's up about 50% a year on average for the 5 years. Gold and S&P are studying the cost of capital at 14%. My company's strategy is up 71%, equivalent to NVIDIA. There's no other stock in the S&P that's done any better. So I think the volatility comes with the territory. If you're going to be a Bitcoin investor, you need a 4-year time horizon, and you need to be prepared to handle the volatility in this market.
So when you look at the price right now, and then we'll talk about the implications for strategy, but when you look at the price right now, what does the upside at this moment look like to you, and what does the downside in this moment look like to you?
I feel like we put in a pretty strong base of support around here. There's an incredible amount of leverage coming out of the system, a lot of liquidation. A lot of the OG holders were selling at the $100,000 level, and so I'm fairly comfortable at this level. I would think that we'll build from this base and we'll rally from here. Obviously, it's hard to make a forecast for the end of the year right now, given what's happened over the past few weeks, and especially the shift in the macro environment. But, as you know, my view is Bitcoin's going to outperform gold. It's going to outperform the S&P. It is digital capital. And so if you're a long-term investor, this is the place to be.
In terms of the way your fund is structured and the debt that you've taken out to effectively buy Bitcoin, what are the trigger points, just so people understand the full risks involved for you, in terms of some of these preferreds and other things, in terms of where Bitcoin needs to lie, either on the low end?
Well, I mean, it's pretty important to note that we're not even 1.15 times levered. We're very fractionally levered, and our debt that we have is 4.5 years out. So we don't really have any trigger points anytime soon. And if Bitcoin were to fall 80%, we're still over collateralized and we're fine. So our balance sheet's pretty stable. The company's strategy, just like an intelligent bank, would be to build amplification for the common stock using preferred equity. So the equity never comes due. It's a dividend payment declared by the board. It's not a coupon. We can't be in a default. There is no credit default situation from the digital credit that we're selling at this point.
I was curious if you could comment on something we heard from Cathie Wood last week. You know, she has a target, I think by 2030, she had it at $1.5 million a coin, and recently suggested it might actually be closer to a 1.2, which is still pretty remarkable unto itself. And yet, when she explained her new rationale, it was actually that stable coins, the sort of emergence of stable coins and the growth of those coins being used for transactions, she argued could ultimately crowd out some of the use case for Bitcoin. What did you think when she said that?
I think the entire digital assets economy is exploding and growing in a bunch of different dimensions. Right now, the way to think of it is that half of the economy is built around Bitcoin. It's digital capital. Bitcoin is digital gold. And the killer application on top of digital capital is digital credit. Instruments like Stretch, STRC, credit instruments that pay yield. And that's a very simple business. The other half of the economy is digital finance. And it's going to be built on the proof of stake networks that are emerging, the Ethereum Solanas, the BNBs. And the killer application for that part of the digital assets economy is tokenized currencies, a la stable coins, tokenized securities, tokenized real-world assets, tokenized brands, and DeFi in general. Well, that's a very complicated technical development, and I'm sure that stable coins are going to go from hundreds of billions to trillions of dollars, but it's not really competing with digital capital. No rich person wants to buy the currency instead of an equity or a real estate or a capital asset.
Michael, given where Bitcoin's trading right now, are you buying?
We are buying. We're buying quite a lot, actually, and we'll actually report our next buys on Monday morning. I think people will be pleasantly surprised. In fact, we've been accelerating our purchases.
Are you ever not buying, Michael?
No, we're always buying. Bitcoin's always a good investment.
But no, that's interesting, though, in terms of buying today at $95,364 versus buying 2 or 3 weeks ago. You're saying you were buying it at both. If you were looking over the last year, sort of at your average, do you weight the buying based on trading?
We now own nearly 3.1% of the network, and we bought it on a blended average about $74,000 a coin.
If Bitcoin pushes to a new all-time high, its dominance typically surges. This pattern repeats every cycle. Fresh liquidity flows into BTC, causing dominance to spike. When Bitcoin doesn't break a new high, it usually levels off at a steady range, like around 10,000 in 2019, or near 100,000 today, slowly drawing liquidity away from altcoins as it moves sideways while alts steadily lose value. In both conditions, whether trending upward or consolidating, Bitcoin consistently outperforms altcoins. Quantitative tightening further reinforces Bitcoin's strength. Combining Saylor's macro perspective with the technical dominance data shows that Bitcoin's on-chain foundation remains solid. Leverage has been flushed out. MicroStrategy keeps accumulating aggressively, and although stablecoins and tokenization continue to expand in the digital economy, they pose no real threat to BTC.